Unit 1. Basics of Financial Management and Time Value of Money 1. Profit maximization versus wealth maximization. AKTU's favorite question. In MBA exams, differences should always be written by creating a table. Profit maximization. Focus. Increasing only the company's profit. Short-term/long-term. This is a short-term approach. Risk. It completely ignores risk and uncertainty. TVM. It does not consider time value of money. Today's 100 rupees and tomorrow's 100 rupees are equal for it. Wealth maximization. Value maximization. Focus. Increasing the market value of the company's shares, which directly benefits the shareholders. Short-term/long-term. This is a long-term sustainable approach. Risk. It keeps risk in mind. TVM. It fully considers the time value of money. That is why it is considered superior. 2. Time value of money. TVM. Concept. A bird in hand is worth two in the bush. Money received today is more valuable than money received tomorrow, because today's money can be invested to earn interest, and due to inflation, the purchasing power of money will decrease tomorrow. Compounding. Calculating future value. What will be the future value of today's money? Formula. FV equals PV 1 plus R to the power of N, where R equals rate of interest, N equals number of years. Discounting. Calculating present value. What is the value of money to be received in the future today? Formula. PV equals FV/1 plus R to the power of N to the power of N. Unit 2. Capital budgeting. Crucial for numericals and theory. Deciding which long-term project, machinery, new factory the company should invest money in. There are three main methods for this. 1. Payback period method. Definition. In how many years will your invested money, initial investment, be returned? Accept/reject rule. Accept the project that has the shortest payback period. Pros and cons. It is easy to calculate, but it ignores TVM and does not look at the profit coming after the payback. 2. Net present value. NPV, SABC important. Definition. Calculate the value today, present value, of all the money that will come from the project in the future, cash inflows, and subtract the money being spent today, cash outflow from it. Formula. NPV equals N airy summation, C euros in a value euro 1 plus R, minus C0, where C0 equals net cash inflow during the period T, C0 equals total initial investment costs, R equals discount rate. Accept/reject rule. If NPV greater than 0, positive, accept. If NPV less than 0, negative, reject. 3. Internal rate of return, IRR. Definition. This is the specific discount rate at which the project's NPV becomes exactly $0. That is, PV of inflows equals PV of outflows. Accept/reject rule. If IRR is greater than the company's cost of capital, K, IRR greater than K, then accept it. Unit 3. Cost of capital and leverages. 1. Cost of capital components. Companies do not raise money for free. Every source has a cost. Cost of debt, K_D. When a company takes a loan or issues debentures, it gets the benefit of tax shield, because interest is tax deductible. Formula. K_D equals R1T, where R equals interest rate, T equals tax rate. Cost of equity, K_E. The return that shareholders expect. It is calculated using CAPM, Capital Asset Pricing Model. Formula. K_E equals R_F plus beta, R_M, R_F. 2. Weighted average cost of capital, WACC. Concept. A company's total money comes from different places, some debt, some equity. WACC is the overall average cost. If a numerical comes in the exam, a table has to be made. Source of finance, equity, debt. Amount, proportion/weight, W. Specific cost, C. Weighted cost, W times C. Total everything. WACC will come. 3. Leverages. Very important for 10 marks. Leverage means magnifying your profit by using fixed costs. Operating leverage occurs due to fixed operating cost, like rent, depreciation. It tells how much change will occur in EBIT, operating profit, due to a change in sales. Formula. Degree of operating leverage, DOL, equals contribution/EBIT. Financial leverage occurs due to fixed financial cost, like interest on loan. It tells how much change will occur in EPS, earnings per share, due to a change in EBIT. Formula. Degree of financial leverage, DFL, equals EBIT/EBT. EBT equals earnings before tax. Unit 4. Working capital management. 1. Concept and types. The money required for day-to-day operations. Gross working capital, total current assets, cash, inventory, debtors. Net working capital, current assets minus current liabilities, CACL. It tells what the company's actual liquidity is. 2. The operating cycle. Definitely draw this diagram in the exam. Cash right-pointing arrow. Raw materials right-pointing arrow, work in progress. WIP. Right-pointing arrow, finished goods, right-pointing arrow, debtors. Accounts receivable. Right-pointing arrow, cash. The longer the cycle, the more working capital will be required. 3. Determinants of working capital, factors. Write headings and explain 2 to 2 lines inside. Nature of business. Trading firms need less. Manufacturing needs more. Scale of operations. Body companies ko zyada WC chahiye. Business cycle. Boom period mine zyada WC. Recession mine cam. Credit policy. If you give credit to your customers, then your money will get stuck. Therefore, more WC is needed. Unit 5. Capital structure and dividend policy. 1. Capital structure theories. Net income, NI approach, says that debt is cheap, therefore using more debt reduces WACC and increases company value. Capital structure matters. Modigliani-Miller, approach. In perfect markets with no taxes. This is an irrelevance theory. They say that whether you bring money from debt or equity, there is no effect on the company's value. Value depends only on how your assets are performing. Capital structure doesn't matter. 2. Dividend models. Numericals come from here. Walter's model. ये कहता है कि dividend policy company की value को affect करती है. Formula. P equals plus R/K underscore E ED / K underscore E, where P equals price of share, D equals dividend per share, E equals earnings per share, R equals internal rate of return, K underscore E equals cost of equity. Logic. If R greater than K underscore E, company is earning well, then the company should keep the money with itself, 0 dividend. If R less than K underscore E, then 100% dividend should be distributed. Gordon's model. This is also a relevance theory. Their logic is that investors like today's dividend more than future capital gains. Bird in the hand theory. Unit 1. Foundations of finance and time value of money, TVM. 1. The agency problem. Best topic for writing long answers. When a company becomes large, the owners, shareholders, are different, and those running the company, managers/board of directors, are different. Conflict. Shareholders want their wealth to be maximized, share price to increase. Managers might focus on profit maximization for their bonuses, big offices, or power, or take projects that benefit them. This conflict of interest is called the agency problem. Solution. To solve this, managers are given ESOPs, employee stock ownership plans, so that they also become owners of company shares and think like shareholders. 2. Time value of money, TVM, in depth. Money loses its value with time, inflation, and money earns money with time, opportunity cost interest. Compounding, future value. When interest is earned on interest on today's money, it is called compounding. Formula. FV equals PV1 plus R to the power of N. Pro tip for exam, mention rule of 72. If you want to check in how many years money will double, divide 72 by the interest rate. E.g. R equals 8%, then 72 divided by 8 equals 9 years for money to double. Discounting, present value. If someone will give 100,000 rupees after 5 years, what is its worth value today? Formula. PV equals FV/1 plus R to the power of N. Annuity. When a fixed amount is received continuously every year, like rent every month or insurance premium every year. Its PV and FV are calculated in a different way. Unit 2. Capital budgeting and investment decisions. Capital budgeting decisions are irreversible. Once the factory is set up, you cannot go back. Tools to evaluate these. 1. Accounting rate of return, arranged by. This is the only method that focuses on accounting profit, EBIT, etc., instead of cash flow. Formula. ARR equals average annual profit, average investment times 100. Advantage. It is very easy to calculate. Disadvantage. It completely ignores the time value of money. 2. Net present value, NPV, the gold standard. Calculate the value today of as much money as will come, and subtract from it as much money as is being spent. Steps for exam. Estimate cash inflows per year. Discount them using cost of capital K. Sum all present values. Subtract initial outlay, $C_$0. Formula. NPV equals N area summation, C0.1 plus K minus C0. 3. Internal rate of return, IRR. IRR is that magical percentage where your profit and your cost become equal. If you have created complex financial models, you would know that calculating IRR is just like using goal-seek in Excel to find that interest rate where the NPV value becomes exactly 0, 0. Acceptance rule. If IRR cost of capital, accept the project. 4. Profitability index PI. If you have less money, capital rationing, and many good projects, then PI is used. Formula. PI equals PV of cash inflows / initial investment. Rule. If PI greater than 1, accept. Unit 3.